Hello everyone, we're going to do aged accounts receivables, or basically how to write off bad debts and how to calculate bad debts. The first one we're going to talk about is two different methods you can do this. Method A is a percent of sales or credit sales. It's done the same way. And then part B is percent of the accounts receivables, also known as the balance sheet method. And then the journal entries that we'll have for each of them. We're assuming this is my credit balance to start with. I have $3,250 in the accounts already. So what we want to do is how we do this. Okay, the first method A here is the journal entries 4% of net credit sales. Well, we don't want cash sales, so we just take the credit sales. So for that, for A, let's put A down here. For A, we'd have credit sales was $273,900, and we want 4% of that. So we multiply those out, 273,900 times 4%, and that gives us 10,956. Okay, now that's going to be for the sales method. That is our adjustment, because that's what you adjust it by. So this would be for 10,956. 10,956. Okay, let's put this up here so it looks a little nicer. So we would credit the account for allowance of doubtful accounts, 10,956. And since that's a credit balance already, we would add the two together. In our account, then it would be 14,206. Now for this was for method A. I'll put that for A. For method B, however, it says 6% of the accounts receivables. Well, we have 128,600 in the account, and we want 6%. So we multiply these two. 128 times the 6%, which gives us $7,716. Now the difference between these two methods, though, this is adjusted by the amount, this is adjusted to the amount. So up here we want 7,716 in the account, which means our adjustment then is the difference, the 7,716 minus the 3,250. So it would be, our adjustment then would be 4,466. And that's the amount we'd do the adjusting entry for, because that's what we adjusted. We adjusted to the amount. So the difference is sales is adjusted by the amount you calculate, accounts receivables adjusted to the amount you calculate. Okay, the journal entries are the same, it's just how you calculate it. This is adjusted by the amount, this is adjusted to the amount. And that's the key there. Okay. Now, on the other way we can do this is aging of the receivables. And I got those already figured out for you, so I'll take those off. Aging the receivables, and the idea for this is that each time as these receivables get older, they get more likely to be uncollectible. So they'll give you here's the dollar amount, and you multiply it times the percentage it's uncollectible. Okay, and you do that for each of these as you go down. So the last was 12,000 times 0.65. So the total is the auto sum, so 39,350. Now we're going to do it a little different here. Remember, this is adjusted to the amount. Okay, so on our balances here, we want 39,350 in each of these accounts to end up with 39,350. I forgot the zero there, didn't I? Okay, and this is going to be 39,350. Okay, so what we have to figure out, how much is our credit? Well, we start with the zero balance there, so that's just going to be 39,350. Okay, so that one will be 39,350 and 39,350. For this one, however, we start with a debit balance, so we'll have to basically add those two together. So we have 39,350 minus 39,350, and I don't want that as a minus. So I can do an absolute. So I need this one to be 42,850. And because you have to get the 3,500 to 0 first, and then add 39,350 to that. And then this one would be the difference between the two. This one minus this one, or 36,600. Sorry. And I could do this the same way. Equal the, yeah, that's what the problem is. Okay, this would be equal 39,350 minus 3,500, which is a 42,850. Okay, remember the accounts receivable method is adjusted to the amount is calculated, not by the amount is calculated. Okay, now the other one we have here is the net method versus the gross method. This is a little different. I need to expand that so you can probably see it. Deca Corporation sells merchandise with a list price of $15,000 on December 1st, with terms 110 net 30. Remember, the 110 is 1% discount if paid within 10 days. The net is due in 30 days. On December 10th, payment was received on merchandise originally billed for $8,000, and $4,500 was received on December 31st. Okay, so my original entry here would be for, under the gross method, is 15,000, 15,000. This is the way you have been doing it. Now, when they paid the 8,000, well, it was originally billed for 8,000. Take off the discount of 79.20, and then we put a debit sales revenue for the discount of $80 and accounts receivable for 8,000. Now that's a little different than what we used to do. You used to do sales discounts, and now they're doing sales revenue. You're reducing the sales revenue account. They don't want a sales discounts anymore. And then at the end, he paid $4,500 and $4,500. Now you notice he still has a balance on the account, because on the account we started with 15,000, paid 8,000, reduced it by 4,500, so the account has in it $2,500. Okay, now for the net method, this method you're going to record it with the discount taken off. So this would be the 15,000 times 0.99, or 14,850. The other way you could do that is take 15,000 times 1%, which gives you 150. Subtract that from the 15,000. So that's 14,850. Now, when you received the check for the 79.20, that was within the discount period, so that'll be simply 79.20. Now here you received a check for 4,500. You can do this one of two ways. They will do the easy way first. 4,500, 1% of that would go back into the sales revenue account, because that was not part of the accounts receivables, because you don't get full credit because you're past the discount period, and you'd receive $44.55 for it. And then the end of the year, this will be another $25 in here, and I'll show you how to get that in a second. Not 250, 25. Because what we have here is we started with, I'll do it down here. You have 14,850, and then you subtract 79.20, and so have a 44.55. which gives you an auto sum of 24.75. Okay. Now the $24.75 is your discount. So to get how much you should have in the account, you equal to $24.75 divided by 0.99. So you should have $2,500 in the account. So the difference would be $25, and that's what your adjustment would be for, is the $25 that you're short. Okay, that's the easy way. Because what you're actually doing is you're saying, okay, $24.75 has to equal to, let's say, X plus 0.01 X. Okay, that's what you're actually saying. No, not plus, sorry. It's minus. Okay, so $24.75 is equal to 0.99 X. And then if you divide, you'll have X is equal to 2,500. Okay, and that's what you're actually doing. All right. So that's the quick version of the net price method and the aging of the receivables and the bad debt comparisons of the two different methods. Okay, so I hope that helps, and see you in the next video.